$500,000, a $500,000 I am down in the public count in the last little bit of time. And a woman said, because I posted my portfolio, she said, "Oh my gosh, you lost $500,000. Like, that's insane." Right? I want to address that. I want to talk about losing $500,000 and my perspectives on the gains and the losses in a portfolio. And I think that can help a lot of you guys out in the market, whether you've been in the market for the last few months or whether you've been in the market many years. I think this will kind of help shape a positive perspective out there in regards to these gains and these losses, right? From there, we're going to talk about Tesla stock. Tesla stock has fallen now 52% in the past 3 months. Absolutely devastating move in regards to Tesla. We're talking about where the bottom's at in regards to Tesla, my opinions on everything that's going on here, and we'll go a little nitty gritty in regards to Tesla. After we are finished up with that, we're going to go ahead and react to some NVIDIA videos, because NVIDIA was very much in the news here today because of the GTC keynote by Jensen, and so we'll react to Fast Money Traders talking about NVIDIA here. Stacy Razcon of Bernstein talking about it's NVIDIA's game to lose. Looking forward to reacting to that one. And then last one up here, investors are selling into any strength with NVIDIA. And why is that occurring? So we'll get into that as well in this video. This is a 2-for-1 day, folks. A very rare occurrence here on the Reaction channel where I post 2 videos in one day. So I appreciate y'all for being here as always. All I need from you guys, one thing only, and it's for you to smash that thumbs up button on this video. I hope you guys enjoy these videos. I enjoy posting them for you. And additionally, if you want to subscribe to the channel, you can certainly subscribe. We are now, 84,000 subscribers, maybe 83,000 or 84,000, somewhere around there. So appreciate y'all for being here. Okay. Let's address the elephant in the room. Losing $500,000 in the public account, just like that. Well, here's my perspectives on that, right? If we go back 2 years ago, the public account was around $1.2 million, okay? If we go back a year ago, right around this time a year ago, the public count was around $2.1 million range, okay? As of today, fancy. Sounds good. That car sounded good. That lime green special right there. As of right now, the public count's just under $2.8 million, right? So we could say lost 500,000, or we could say gained, 1.6 million. Like, you know what I mean? Like, we could say a lot of different things in regards to this. The moral of the story is the count is trending higher and higher and higher and higher and higher, right? As the years tick on here. And this is a portfolio that's probably, maybe 8 years old now at this point in time, somewhere around there. And we built it to now almost $2.8 million portfolio. If I look out 8 years from now, I think this portfolio is probably going to be, easily $5 million portfolio 8 years from now, but probably closer to $10 or $15 million if we look out 8 years from now. So it says 2.8 million right now, and I'm thinking 8 years from now, I'm thinking like this is like a 10 or 15, $20 million portfolio. So whatever the short-term stuff is in regards to the market, it's here today, gone tomorrow. Tariffs, taxes, Doge, blah, 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 blah. It's all here today, gone tomorrow. The moral of the story is great companies continue to do great things and they appreciate over time. So where I like to really focus my attention in time is really around returns of the portfolio over time, right? And so if I pull up the 5-year returns for the public count, this is calculated by Fidelity Investments. The 5-year cumulative pre-tax return for the public count is 341%. That's versus S&P 500 at 142%. And that's versus the Dow U.S. Total Stock Market Index at 138%, right? So we're doing very well. We're doing very, very well if you compare us against the indexes, right? Additionally, once the 10-year returns hit, I think they're going to be even more dramatic than what you're seeing in front of you. And that's already pretty insane outperformance there, right? So that's what I really like to focus on. Am I destroying the market over a 5-year span? Good. And then once this portfolio has 10-year returns, we'll put up the 10-year returns calculated by Fidelity, and it's going to be pretty extraordinary as well. So all the other short-term, how a portfolio fluctuates in 1 week or another week, it means nothing to me. And keep in mind, someday when this portfolio is $10 million, you're going to see fluctuations of $1 to $2 million on a regular basis. So I will lose $1 million just off a 10% correction in the portfolio. Right? If we get a 20% downdraft on a $10 million portfolio, that's $2 million lost, right? So just keep in mind, the numbers are just going to get bigger and bigger and bigger as the portfolio gets bigger. Someday, if I want to keep running this portfolio long term, probably be a $25 million portfolio, $50 million portfolio, right? And then a 10% on a $50 million portfolio is now $5 million. Oh my gosh, I just lost $5 million, right? 20% move, we're talking about $10 million then. So that's just like the cost of doing business. The portfolio amounts get bigger. Now, I also want to push back against this asset allocation here because, Fidelity gives you this asset allocation here, and they say your asset allocation resembles a most aggressive strategy, right? And I want to push back against that. I want to say, is a public account really the most aggressive strategy, right? Let's think about this. Let me push back against this for a moment. Okay, so Meta, arguably the greatest business model in the creation of mankind, right? A service in which 3 billion plus people use their services, right? A diversified between Facebook, Instagram, WhatsApp, the VR future, the AI future, one of the strongest income statement, balance sheets, cash flows you will ever see in your life, right? And a very fair valuation. So I just have a lot of trouble calling that a most aggressive strategy, investing into Meta stock, okay? My second biggest position in the public account is a company named Amazon. A company that if you look out decades from now, they're still growing. The e-commerce business is not going to stop growing anytime soon for decades, right? Like if we look at decade after decade after decade, like that business is going to grow for 50, 100 years in the future. AWS is a backbone of business, right? That's not going to be disrupted anytime soon. And then you think about their advertising platforms just continue to get bigger and that revenue just continues to go up. And once again, it's just another company that throws off incredible amounts of cash flows, and their cash flow story is still early days. We got a long way to go here in regards to Amazon cash flow story. I mean, can you imagine Amazon's cash flows 5 years from now, 10 years from now, 15 years from now, right? I just have trouble thinking like Amazon's the most aggressive investing strategy. PayPal, AMD, Tesla, you could say, okay, that's maybe aggressive, right? 6%, okay. We'll talk about Tesla in just a moment. Palantir, you can say, okay, 6% of the portfolio, that might be aggressive because Palantir obviously trades at a very rich valuation, but they also have extraordinary growth rates, and they also are another company that's set up for, like, when does Palantir stop growing, right? I don't know, 10, 20, 30 years from now. I think someday Palantir will stop growing as a company, but it's so long from now, right? Their growth rates are probably going to be extremely high for the next several years, so I mean, yeah, someday Palantir is going to stop growing. So the only way you could push back against Palantir being aggressive is just like the valuation, right? Nike, come on, man. Nike's been around here for decades and decades, and every decade they remain to be more relevant than the previous decade, and they continue to do that. Cake, I mean, as solid comes with another company with 10, 20 years of growth in front of it between their multiple different concepts, right? Celsius, it's just a very stable business. I mean, at the end of the day, it's energy drinks. Recessions happen, inflation happen, all that stuff. People are still going to drink their energy drinks. That's just a bottom line with that, right? And so that's another company that's still very early days in regards to their revenue story and their profitability story. Estee Lauder has been around for many, many decades and has an extremely successful business and is trading at among the cheapest market cap it's traded at in many years. I think they're looking good. Elf is a company that's resilient in any environment. It doesn't matter. Tariffs, inflation, doesn't matter. Elf puts up numbers, right? Fubo, you can say, okay, that's an aggressive stock there, but it's 2% of the portfolio. So Revolve, one of the best income statement balance sheets you'll ever find from a small cap company. 2% of the weighting, I just don't find that being an aggressive stock. Honest sells diapers, lotions, soaps, shampoos, makeup. Not in now the company's got a war chest of cash piled to the sky, and they're getting a profitability. I just don't find that one very risky. SoFi, okay, you can say maybe that one's a little risky because they're banking, fintech, and you can say maybe Planet, but those are extremely small positions in relation to the portfolio. But you look at many of the companies I own, they're the strongest, greatest companies in honestly the world that you would want to invest in. And that's where I have my big dog money. So the fact that Fidelity says this asset allocation resembles a most aggressive strategy, not in my eyes, but hey, to each its own, whatever they want to say. Alrighty, let's talk about Tesla. as a shareholder of this company many times, I've been through a lot in regards to Tesla. And this is probably I'll say this. This is the least bullish I've been on Tesla throughout my investing history in regards to Tesla, right? Now, it really has nothing to do with the stock. It has everything to do with this man, right? And what Elon Musk, I'll put it to you like this. For the past 3 years, Elon Musk has put an incredible amount of time and attention into two areas. Twitter, which is now known as X, right? By the way, if you don't follow me on X, you can do so. I have that linked in the description area down there of this video. I post a lot of stuff on X all the time. And the other thing he's put a ton of time into is politics, right? Or political related subjects. They get into Republicans versus Democrats and all this stuff, okay? Alrighty. Imagine just for a moment if Elon Musk had put all that time and attention that he has put into Twitter and put into politics into Tesla. There's absolutely, positively no doubt in my mind that Tesla would be tremendously ahead of where they are right now. And it's not even close. I have the belief that Tesla would probably be selling 3 to 5 million cars a year. But Elon Musk has been out of office for 3 years now at this point in time. I would really say he's kind of been out of office since 2021 going into 2022. And he's doing bare minimum required at Tesla because he spent so much time on X and Twitter over the last few years and so much time in regards to politics and everything that's going on there. So we basically have a CEO that has been out of office for 3 years now. And it's really showing, right? And then obviously you take it a step further and how much damage he has created for Tesla's brand is really unparalleled, right? The brand he built there really from, let's call it the brand he built at Tesla, really from 2011 to 2021 was legendary. And what he has done to that brand from 2022 to 2025 has been absolutely devastating. Absolutely devastating. So, frustrating, right? It doesn't mean it's not salvageable in regards to Tesla. And here's why. Tesla's technology, the vehicles are unbelievable. Unbelievable. So as somebody that has driven Teslas for many years and has driven the best of the best vehicles in the world, Mercedes, BMW, Ferrari, everything you want to drive, right? I come back again and again, Tesla makes unbelievable vehicles and they make your life so convenient. Everything just is so seamless that you never want to not have a Tesla once you have a Tesla. But with that being said, the brand is in an awful place. It's in an awful place in the United States. It's in even a worse place in Europe. And I don't think it's in nearly as good of a place as it was in China. And so therefore, those are the 3 main markets for Tesla. That makes it brutally tough. Now, additionally, we really have nothing super exciting going on right now in regards to the company. We got the Model 3, Model Y, Model S, Model X, right? Cybertruck, the brand's been hurt so much that product is not nearly as cool as it once was because the brand's been hurt so much. And you got to understand, when you hurt the brand so much like that, it affects negatively all the sales of all the vehicles. So, the moral of the story is Elon needs out. Tesla, and this is the first time this is the first time I really felt like this recently. Tesla would be better off without Elon Musk than with Elon Musk. And that could not be said in past years. In past years, like if we go back 5 years ago, 10 years ago, no way would I ever say that. I say, oh, we need Elon Musk at the helm. He's so important. He's so vital to the company. Absolutely. Like Elon. We need Elon gone, out of the company. Tesla would be better off if Elon completely removed himself from the company now at this point in time. And so the question is, who would I put in Elon's place? I would put Dara in his place. Dara is the CEO of Uber. He's done a very good job running Uber. Now, I think Dara would consider leaving Uber to come over to Tesla. I really do. And the reason being is Tesla there's so much raw potential there with Tesla. The engineering teams are amazing at Tesla that I really think Dara would strongly consider if Elon said, you know what, I'm out. I need somebody to run this show for the next 10, 15 years. I really think Dara would consider it because I think it would just be a tremendous opportunity. And the thing with Dara is it's not just like if you look at where Uber's revenues were and where its profitability was when Dara took over versus where it is nowadays, it's a night and day difference. So he's done a tremendous job in regards to the financials. But it's not just that. When Dara joined Uber, Uber was in a bad place with their brand. They had just previously had a video go viral all over the internet where Travis might have been drinking, I don't know, okay? But he was in an Uber car and the driver confronted him and it was an ugly situation and made Travis look like an absolute jerk to the world, okay? It did not paint him in a good light. And that was just one of many reasons Travis had to basically take off from the company. Also, the company culture was supposedly super toxic in regards to what was going on with Uber. So Uber had a lot of brand problems, internal, external, everything going on there. And Dara came in and revitalized that brand over the next few years. And Uber, you don't think of anything like that now. You just think of, I'm going to go get a ride from Uber, or I'm going to go, order something on Uber Eats or whatever, right? And he's also built out a very successful subscription business model now. Uber One, in regards to Uber as well, right? Where people will pay, for Uber Eats subscription or Uber Rides subscription. So he's done a tremendous job. And I think he would do a great job with Tesla getting the company back on the right track. I think he would really do it. Because the thing with Tesla, we have so many great engineers at that company. We don't necessarily need a super innovator at the company anymore. We just need a guy that's going to operate, say, hey, we need to come out with this product, this service, we need to do this, get the company all aligned, moving in one direction, and execute. And we just don't have that for the last several years in regards to Tesla, and it shows in the numbers. There's no reason Tesla numbers should be as bad as they are. But they are as bad as they are because of one man, and his name's Elon Musk. Like I said, if Elon was really dedicated to Tesla and putting in all his time, there's no doubt in my mind we'd be selling 3 to 5 million cars a year right now. But we're not. And so, Elon Musk has gotta, it would be in his best interest and everybody's best interest if he took off from Tesla. And then we could talk about, a stock that would be in a much better place. Now, assuming Elon Musk is not going to leave Tesla and he's going to stay around, where does Tesla bottom? Your guess is as good as mine. Could Tesla round trip the whole move over the past few years and head all the way back down to a low $100 level? I don't see why not. What is the super encouraging thing to invest in Tesla right now? I don't see one reason. The brand's in a horrible place, right? That's not going to magically fix itself in the short term, especially with Elon Musk still attached to the brand. Self-driving vehicles, in that being any sort of material business, is years and years away. That's a long time away. What do we have to go off of? The energy business, the growth rates are going to start coming down substantially over this next couple of years. What do we have to be excited about anytime soon? And you got to understand, Tesla stock moves on excitement, and there's nothing exciting going on. The most exciting thing that could possibly go on for Tesla would be Elon Musk stepping down from the company. Alrighty, let's go ahead and react to some NVIDIA videos here.
Answer that question. They did not answer that question in 2 hours. This is not granted for investors. This is not a meeting for investors. But still, that is what has been dogging the stock.
Not a meeting for investors, but every investor is focused on the meeting. So it is a meeting for investors, and I think you're right. Look, Rubin looks like it's a second half 26 story. I think market probably knew that, number one. Margins didn't come up. Robotics, multi-trillion-dollar industry potentially. So he said all the things about the future and they're exciting, but I don't think anything that's been concerning investors or traders, I don't think any of those concerns were assuaged. And I continue to think that, they might talk about a reacceleration of margins in the second half. I just don't see it happening. So this move actually makes sense to me.
And this was not a scripted speech, my understanding. So this is a kind of a free-flowing dynamic. And to the extent that you could have just gotten a little bit more into where the new use cases, in other words, moving away from data centers, moving into There's talk about collaboration with GM on AI, et cetera, et cetera. So the $1 trillion addressable market isn't really new. I think if you look at the stock, from that Jan 7th, at least recent high, it's been making lower lows. So, I mean, we're going to talk about some of the other big mega cap tech stocks, but there's nothing on the charts that tell you that this company is in a safe spot. And semis, continue to look like they're vulnerable.
Is Tim playing hurt here, guy?
Well, that tie would suggest he's playing something. I mean, what is that?
So
is the voice?
Does it get wider?
Melissa told me she loves this tie.
Mel,
She'd like me to wear it more often.
Is he a little
she's
hoarse?
laughing, as if that's not what she's saying.
Nay.
The fever's broken in this trade. Let's just be clear here, right? So if this happened a year ago, whatever he said here, with those throngs of people there who were really excited, the stock probably would have been up 5%. We were looking through the options market. The implied move between today, this morning, and Friday's close was about 6% in either direction. Just think about that, okay? So when you think about what's going on here, the expectations, I didn't think they were going to be particularly high. The company just reported a few weeks ago. They obviously didn't say any real big news for this sort of event, and they probably knew that. The one thing I'll just say is, lots of headlines. When Guy talks about margins not going up in the second half of this year, the information has an article out this morning that Amazon Web Services, they're offering their own chip to cloud customers, same performance as the H100 from NVIDIA, but at 25% of the price. This is how any other semi company who's coming into the space, they're going to compete on price, especially if they have the same performance as the last gen sort of chips. So to me, listen, the story's great, okay? They're expected to grow earnings and sales this year 50%, trades at 25 times. Next year, it's supposed to grow 25%, expected, trades at 20 times. So if you're a valuation person and you believe what they're saying, then the stock is cheap here. But if you think that the fever's broken all around, if you think that the economy is going to get weaker, if you think their major customers are going to pull back in their CapEx at some point or diversify away from a single source, then the story is not that attractive right here.
So it doesn't really matter what Jensen Huang says. I mean, to play the role of Ms. Silver Linings on this desk, and somebody else is not doing that tonight.
Sorry, I missed
The fact that there is no new guidance after 3 weeks after reporting earnings, maybe that is a good thing, considering how we have seen confidence drop off a cliff in so many other industries. For him to stick by that forecast, that wasn't enough still.
No, I think you make a good point, right? They have every opportunity to back away. The economy is slowing. Maybe CapEx is not going to be as robust. I think you're right.
Yeah, but they're missing the point. They're missing the whole point here. The whole point of what's going on with NVIDIA and all the weakness in the stock, right, is really around 2026. That's what everybody's worried about. No one's worried about 2025 numbers. That's silly. We already know the big tech companies have already committed the money for 2025 for chips and all that. The worry is about 2026. The worry is about next year. Where are growth rates in 2026? We don't know. Maybe they're 10%, 15%, 25%, 30%. We don't know. And that's where things are murky. If NVIDIA had a guidance for 2026 of only 10 to 15% revenue growth, I wouldn't be surprised at all. They're coming off just ridiculous comps over the last couple of years. So if they had a lame year with only 10% or 15% revenue growth, I would not be surprised at all. All that would take was just Microsoft and Meta and those sorts of companies just say, we're not going to commit much new capital there, right? So now, how does AMD grow in that market? AMD is coming off such a low base that AMD will be able to grow regardless over the next few years, right? And so they're just coming off a very low base. NVIDIA's got these monstrous numbers, this massive base that, is tough. And AMD's about to hit the market here with some very competitive products starting in mid-year. And it's not going to affect NVIDIA's numbers much at all in the short term, meaning over the next, 3 quarters, 4 quarters. But could it hit NVIDIA's numbers to at least a small extent in a year from now, 2 years from now? Yes. But that's not the major problem. The major problem is Microsoft, Meta, these sorts of companies, Google, they're likely not going to up their budgets much at all, at least in my personal opinion, in 2026. They're either going to cut budgets or they're going to keep them around the same, and they might give some of that money to somebody like an AMD that's obviously coming out with some extremely competitive chips that are likely going to end up undercutting NVIDIA quite substantially.
But I also think the market's trying to get in front of potential slowdown and the potential for CapEx not to be as robust as things, as many of these stocks have priced in. I think that's sort of the rub right now.
So NVIDIA, I do think it's been de-risked a lot in respect of, I wouldn't expect NVIDIA stock to completely collapse from here. All things are possible. I just don't think that's going to happen because the PE ratios come down so much. So if all of a sudden the company, the year goes along and then they say you're only going to grow revenue 10% in 2026 or something like that, or 15%, like it would not be fun for the stock, but at the same time, it wouldn't be that devastating because the stock is already trading at a very fair PE. Now, if they were trading at an 80 forward P, let's say, for instance, an 80 forward P, a 60 forward P, and all of a sudden they said revenue is only going to grow 10 or 15%, then we would have a stock that would be ready to collapse. But if you're trading at a 20-something forward P and you still grow revenue 10 or 15%, that's very fair. So NVIDIA stock sets up well, actually, in my opinion, from kind of a risk-reward standpoint. The only thing that could really crash the stock is if NVIDIA's revenues went negative. Now, that's a big assumption that NVIDIA revenues would go negative. If that happens, then we could talk about NVIDIA stock, going down 30 or 50% from here. But I wouldn't count on NVIDIA's revenues going negative. I would just count on them kind of being much more modest than they've been in the past few years.
Searches. Stacey Raskin, he's on the ground at NVIDIA's conference. Stacey, great to have you with us. We were talking about NVIDIA and how, this is not necessarily the audience for it. I mean, Jensen had a lot of technical things to talk about. But in terms of answering the burning question of investors, and that is the CapEx spend picture in place? Is that steady? Is it rock solid? Did you get anything from what he said today to answer that?
Well, I mean, at this point, I don't think that we're seeing any signs that it's at risk. If anything, he gave us a view of the roadmap going forward for the next several years, and the performance improvement and the total cost of ownership improvement for the future platforms as you go from Blackwell to Blackwell Ultra to Rubin Ultra, to even talk about Feynman in 2028. We're talking another, I think, more than an order of magnitude improvements in performance and total cost of ownership for the next couple of years. It is going to be a very NPV positive thing for customers to upgrade. So I don't think we heard anything that Jensen said that would suggest that CapEx budgets are getting ready to roll over. And again, who knows? We'll see when we get there. But at this point, I thought it sounded great. I thought he did a great job.
Yeah, you won't know right now. Jensen won't know. No one knows. Like, the big tech companies really start figuring out their next year budgets in the third quarter and fourth quarter of a year. So right now, these companies have already set their 2025 budgets. They'll assess what they want to do for 2026 in the third quarter and fourth quarter. So you got to still get through the spring and in the summer. And then in the fall time, that's when NVIDIA is going to start to know, are these guys getting ready to cut back? NVIDIA will probably know even before investors know, because usually companies like this will place orders months in advance, essentially, if not a quarter in advance or two. And so you'll know if Meta is going to cut budgets or keep budgets the same or up budgets based upon what NVIDIA's guidance is looking like at the very end of this year. So Jensen can't say anything. No one knows anything right now. We'll find out more later on this year, right? At the end of this year, essentially.
There's still skepticism, though. I mean, that's the thing with investors. If you are a believer that there is a growth scare, that there is a recession on the horizon, can you be bullish, NVIDIA? I don't think NVIDIA outperforms.
I don't think that's an NVIDIA question, right? That's an everybody question. If we're going into a recession, I mean, semis in general tend not to do well in recessions. Again, there are some secular drivers here. I think they can hope to offset some of that. Clearly, the AI spending is happening. There are business models, cost reductions, revenue models that are starting to get built on this stuff. There's this whole long-term trend that he talks about as you move from.
Let's be very clear here. In a recession, let's say we actually go into a recession, right? 2026. Let's say a recession hits 2026. Listen, AMD is still going to have great growth, regardless of recession or not. NVIDIA business is still going to be relatively at least stable, even in a recession. And the reason being is, who are these companies' biggest customers? They're the biggest, strongest companies in the world. The type of companies that are, I want to say recession-proof, but pretty darn close, right? Like Meta. Meta's going to put up numbers regardless. It's just a question of, our growth rates 5%, 15%, 10%, 20%. That's the only question. Microsoft's going to put up numbers regardless, right? I mean, people are going to stay subscribed to all their Microsoft products and the cloud and all that stuff. Like, don't matter what, Microsoft's still going to make crazy money. Google's still going to make crazy money. Meta's still going to make crazy money, regardless of recessions or not recessions. So that means they can continue to invest in their businesses, regardless of recessions or not. So now they might not invest as aggressively, but they're still going to invest a lot. And so, like investing into AMD, I'm not scared of investing into AMD even if we were to go in recession at all. AMD is going to grow regardless, in my personal opinion, based upon the chips they got coming out and the type of companies they're going to be doing business with. I'm 0% worried, right? Obviously, I'd rather have a better economy because that means their numbers will be even better over the next few years. But regardless, if companies want to get a little more value conscious, they'll go to AMD, right?
Or traditional computing to accelerated computing, which is a massive cost saver. So there are other drivers. Again, in a recession, you want to save costs and dial back. And these are investments I think that can pay off. But I mean, if we go into like a significant like global or local recession, I don't think anything in semis does all that well. At least NVIDIA does have some of these structural drivers. And I've said this on the program before, but it's not even expensive. It's like in the low 20s if the current numbers are
exactly.
Low 20s price to forward earnings if the current numbers are anywhere close to being correct. And like there's a lot of other things out there that are much more expensive that I think are likely to get hit just as bad or worse from a fundamental standpoint in a recessionary environment.
That's fair.
Yeah, so price to earnings, you're right. But, Dan just mentioned the competition coming, and obviously we saw deceleration. Well, I mean, you probably were listening to some of the things that Dan said. I mean, we heard from Alibaba. We heard a month and a half ago about the DeepSeek things. I mean, clearly people are going down that road. Whether or not they can catch up remains to be seen, but they will compete on price. So I guess my question is, how concerned should we be about potential margin deterioration from here?
Again, I don't think it's about price. Like the price of the chip is only one component of the purchase decision. What really matters is total cost of ownership. So that's the price of the chip and the power and the cooling and like everything else that goes into it over the lifetime of that chip's lifetime, based on what kind of performance you can get out of it over that time frame. And I think NVIDIA, I mean, even today, I mean, you can see where the dollars are flowing. They have the lowest TCO. And if you look at, again, the roadmap and the improvement trajectory that they laid out today, I think it's going to be hard-pressed for many of theirs or any of their competitors really to have a significantly better TCO. And that even that ignores the fact, like everything else that they're doing around software, around systems, hardware, ecosystems. They talked about co-packaged optics now that they're bringing into place, networking. They're the only ones out there with a full stack hardware and software solution. Like nobody else has that. Like I'm not terribly worried about their ability to compete.
Stacey, it's interesting.
AMD is very close, especially once that deal with ZT Systems goes through.
What competition with a big question mark? Maybe two question marks after that. And, when I look at the analysts, there's 76 that cover it. 70 have an outperform or buy on it. The average price target's $172. The stock's trading at $115. It's down 25% from its all-time highs. So there's a disconnect between what investors think and what Wall Street analysts think. And then when I hear Wall Street analysts be really skeptical about any competition, we've all been doing this a long time. That competition comes from the place that you don't expect it. So I really want to focus on the disconnect between what investors see and selling it and versus what the analyst community thinks.
Sure. So first of all, it's not just NVIDIA. Like there's been a broader degrossing. It's not just NVIDIA that's come down. I do think that, again, there was some nervousness. There was the whole DeepSeek thing, which, by the way, I think the only thing we've seen since DeepSeek was infrastructure spending going up, not down. And my view on DeepSeek, again, we may have talked about this, is I thought DeepSeek was actually good news, not bad news, but it is what it is. You can look at where the competition is driving. There's other merchant suppliers. You have AMD, and I guess maybe Intel's still in there. And again, I don't think AMD. I even question the need. Frankly, I mean, in terms of second source, I really do think it's going to be the hyperscalers doing their own chips. These are ASICs, and Google does TPUs and everything. I think it's the wrong time to worry about it. I think the right question to ask right now is not who's winning or losing between like GPUs and ASICs. Is the opportunity in front of it still big or is it not? Because if it's still big, then they can both thrive. If it's not, they're both screwed, right? So I think you have to believe that we're not on the saturated part of the S curve now. I don't think we are. My guess is the market. I think I said this. It's NVIDIA's game to lose. Like I think full stop at this point. They're not showing any signs right now that they're losing.
So first off, I think he's I don't know why Stacy never gives respect to AMD and what they have in the marketplace coming here. I think he's making a big mistake in regards to that, right? He's not taking AMD nearly serious enough, and I think he should take it much more serious. He seems like he's just like, just NVIDIA fanboying and not really looking at everything AMD has going on and everything they have coming, and training versus inference, and how AMD chips could really benefit from inference specifically over this next 5-10 years. So, and then all the acquisitions they've done over the past year or two that have really positioned them to be in a very successful place for this next 10 years. Intel, I wouldn't take them serious. Like they're in a whole world of trouble in regards to Intel. But yeah, competition is not the main problem. The main problem is just trying to get Meta, Microsoft, Google, all these companies to then go ahead next year again and say, you know what, NVIDIA, we're going to spend another 25% more with you, 35% more with you, 45% more with you than we spent this past year. That's the issue. And that's the only issue. That's really the only issue with NVIDIA. Because in order to put up great growth numbers again, they're going to need Meta, Google, Amazon, Microsoft, all these companies say, you know what? We're going to spend another additional 20% next year, 30%, 40%, 50%, because that's where the money actually comes from. OpenAI, we're going to spend another extra 30%. And I just don't know if that's coming, to be quite honest with you, for NVIDIA in 2026. And that's where the whole problem comes from. And who was the one that called out this whole problem, almost a year ago now? Called this out way before, and now, this is like a big subject that's talked about everywhere, and it's like, I told people like this was going to happen like back in 2024. I was explaining like this was going to be an issue. Like 2024 numbers are great, 2025 numbers are great, 2026 we're going to start having a problem, everybody's going to start questioning numbers, and then boom, everybody did exactly what I said they were going to do.
Dana, D'Auria, guys, good to see you both. So, Paul, NVIDIA didn't rescue the mega caps today. What does that mean for reaction to the Fed's tone tomorrow, you think?
So I think in NVIDIA, it could be the greatest thing since sliced bread. Jensen can say whatever he wants, but the most important thing, as we said when I was on the day they reported earnings, is the reaction to the news. And if you see what happened in NVIDIA today, the stock peaked right at 1 o'clock and investors sold into the news there. That's been happening with every rally in NVIDIA over the last 6 months. And until that pattern changes, it doesn't matter what they say. Investors are selling into any strength in the stock. So I think in that respect, for the stock itself, that's not a great sign. But for the Nasdaq itself, NVIDIA closed near the lows of the day today. But the Nasdaq, since from about just a little before 10 to the close, it traded in a relatively tight range there, and we didn't see the late day sell-off, which has become so common. So I think going into tomorrow, the Fed decision, I think there's not going to be much of a surprise in that. So, I wouldn't read too much into what the Fed's going to say. I think the market's just going to try and find its bottom here, and we're going to see that over the coming days, maybe weeks.
Well, Dana, investor sentiment certainly seems to be souring, but U.S. stocks still aren't cheap by historical standards. So at the same time, huge day for Europe, its largest economy. Germany votes to open the debt floodgates. So where should investors place their bets?
Well, I think you're onto something there, right, with international. I mean, look, we're proponents in general of international diversification. What's happening right now in the U.S. is a prime reason for that. Having a portfolio with, not only ballast and fixed income, but also diversified across economies. Because look, I mean, the U.S. markets have dominated for so long. I do a lot of CIO panels. If there's any theme that seems to be constant in the last couple of months, it's been U.S. predominance. So, for sure. You should have international diversification, right? So I think for precisely that reason, for the contrarian signal of it, I think investors in general need to diversify just in order to deal with the uncertainty that we have right now. I mean, you look at what happened when we were going into this administration. We thought we'd be moving away from China, more Mexico, maybe more Canada, more friendlies near us. And then, of course, tariffs completely upset that. So, I mean, I think the market is dealing with such uncertainty. You really do, what you gain from a diversified portfolio is even more important in a market like this than typically.
Paul, in the near term here, I just wonder how much noise is in this market. And I ask that knowing that Friday we've got an OPEX.
So one of the big problems that, one of the big mistakes I would say investors make in a market like this is they look at whatever's going on short term and they start thinking, you know what? I need to do this thing because of the short term thing that's going on. Oh, this tariff threat, blah, blah, blah. So I need to buy European stocks because European markets are outperforming the U.S. markets right now, or whatever. Like they start running these conclusions based upon short-term things, and they start missing like the long-term horizons. In the stock market, it always pays much better to just focus on the long-term opportunities, the long-term great companies that have years and years of growth ahead, right? And that you can easily see how this company gets bigger and bigger and bigger over the next 5-10 years. And focus your time and attention there, right? And so when I look at somebody like an Amazon, perfect example of a company, like I can picture it literally exactly how Amazon continues to grow and grow and grow for many years to go in the future. Next point I want to push back on here is, the market being so expensive. But where though? Is Meta very expensive here? No, Meta's cheap. Meta's trading at a forward P in the 20s right now, low 20s likely, with double-digit growth for years to go in the future. No, that's not expensive. Amazon, same exact situation. So that's I wouldn't say that's very expensive. Google's trading very cheap right now. Now they're going through a bunch of government issues right now, so they're probably cheap for a reason. But still, like you can't say Google stock's expensive. Like Google stock's cheap. Nvidia stock, you can't say that's expensive here, right? You can say it's either fair value or undervalued here. AMD's undervalued here. If we want to look out to Apple, Apple, you could say maybe a little overvalued, but at the end of the day, it's Apple. People break an iPhone, they go buy another iPhone. They break an iPad, you're paying for that stability. The services revenue continues to pour in. It's almost like, just a guarantee for them. So even they're hard to make an argument that they're expensive here. Microsoft's business is one of the greatest business models in the world that just continues to recur. And so that business model, at their PE, their forward P is likely in the high 20s right now. That's not expensive. So I'm just trying to find, where's the market so expensive, right? And you look at the Russell stocks, small cap stocks are trading extremely cheap right now, right? So, the travel-related stocks have come down immensely in valuation. Many of them have been cut in half or more. So it's hard to really find where the market's so expensive unless you're looking at maybe, healthcare or defensives or something like that. But yeah, there's a lot of steal deals all over the market right now. And I spoke about 8 stocks on the main channel last night. I don't know if you guys got to see the main channel video last night on financial education. I spoke about 8 stocks that are great buying opportunities right now.
It's expected to be one of the largest expirations of all time. You've had this FTSE Russell adopting new rules that limit the influence of the largest stocks, aka the Mag 7. That's expected to affect more than $7 trillion worth of equity funds that are having to reshuffle. In light of that, how much should we be thinking about or factoring in the impact of some of those moves technically here, at least in the near term, versus the bigger picture as we do come out of this correction, which I know you've got some historical context for us on as well?
Yeah, so I think in that respect, there's always going to be a multitude of factors impacting things. And, so some of these mechanical adjustments, like you just mentioned, Morgan, that can impact things. And to Dana's comments before about talking about international versus domestic, you always want diversification. And as exceptional as the strength has been in international stocks over the last 2 months, on a relative basis, they're back to where they were in October. So they saw historic underperformance from that period, right when The Economist put the U.S. exceptionalism on the cover. They saw a historic underperformance up until January, and now international stocks are seeing a short-term burst of historical outperformance. So I think in that respect, for the market overall, though, Historically, when we've seen these sharp pullbacks and these extreme moves, they tend to reverse themselves over the course of the coming weeks and months. So in that respect, I would think that you've seen some oversold conditions in U.S. stocks, and you should see a bounce here going forward. Maybe not in the next week. That tends to, the market tends to, make the most people upset as possible. But as we go out into the next couple of months, I think you'll see the U.S. stocks start to rebound.
Yeah, in terms of when the market bottoms, I felt like March, it feels about right for kind of a market bottom here, but we'll see. And I'm ready for whatever comes, okay? Appreciate y'all for joining me as always. Thank you so much for being here. If you're looking to apply, join private stock group, private wealth group, get access to all of that. Pin comment down there. You can fill out a form, see if we can get you access to that maybe a little later on this week or next week. That's access to all of my best courses, the private Discord chat with the 6, 7, and 8 figure members, the moves I'm making each week, all that good stuff. Much love and have a great day.